What if I told you a teenager with a paper route and a $10,000 head start turned that money into hundreds of billions of dollars, not by inventing the next iPhone, not by building a tech empire, but by simply investing better than almost anyone else on earth? Before we start the video, hit the like button and subscribe. It really helps the channel and lets me know you enjoy stories like this. Now, let's talk about Warren Buffett. Most people think Buffett's story begins in some fancy boardroom on Wall Street. It doesn't. It starts in Omaha, Nebraska. No skyscrapers, no hedge fund culture, just a regular American neighborhood and a kid who was obsessed with making money. By the age of 6, Buffett was buying 6 packs of Coca-Cola and selling the bottles individually for a profit. That's not a cute childhood story. That's margin thinking at 6 years old. While most kids were trading baseball cards, he was calculating percentages in his head. By 11, he bought his first stock, 3 shares of Citi Service Preferred at $38 each. And here's the part that shaped him. The stock dropped to $27 shortly after he bought it. Most kids would panic. Honestly, most adults panic. But Buffett held on. When it climbed back to $40, he sold, relieved to make a small profit. Then it kept rising to $200. That moment burned into his brain. Lesson learned: don't sell great businesses too early. By the time he finished college, Buffett had saved about $10,000. In today's money, that's roughly $100,000. Still impressive for a young guy in the 1950s. But $10,000 doesn't turn into billions by luck. It turns into billions through discipline and time. Buffett was obsessed with one thing: value. He studied under Benjamin Graham at Columbia Business School, the father of value investing. Graham taught him a simple but powerful idea: buy a dollar for 50 cents. In other words, invest in companies that are worth more than their stock price suggests. Sounds simple, almost boring. That's the point. In the 1950s and 60s, while others were chasing hot stocks, Buffett was digging through financial statements like a detective. He wasn't looking for exciting companies. He was looking for underpriced ones. Textile mills, insurance firms, banks, the kind of businesses most investors ignored. One of those boring purchases was a struggling textile company called Berkshire Hathaway. At first, it was just another undervalued stock. The company was failing, but its shares were cheap. Buffett thought he could squeeze out a profit. What he didn't know was that this dying textile business would eventually become the vehicle for one of the greatest wealth-building journeys in history. Here's where things get interesting. Instead of trying to fix the textile side forever, Buffett used Berkshire as a holding company. He started buying entire businesses through it. Insurance companies became his secret weapon. Why? Because insurance companies collect premiums up front and pay claims later. That pool of money, called float, gave Buffett billions of dollars to invest. Imagine being handed billions to invest, year after year, at very low cost. That's financial fuel. But here's the key. Buffett didn't gamble with that money. He bought strong, understandable businesses. Coca-Cola, American Express, Washington Post, companies with brands people trusted in the US, the UK, Australia, businesses woven into everyday life. He wasn't chasing trends. He was buying companies he believed would still matter 20, 30, even 50 years later. And he held them. While traders checked stock prices every hour, Buffett focused on decades. He once said his favorite holding period is forever. That's not just a catchy line. It's a strategy built on patience most people simply don't have. The magic wasn't just smart picks. It was compounding. If you earn 20% per year consistently, your money doesn't just grow. It snowballs. Over time, growth starts growing on top of growth. That's how $10,000 becomes $100,000, then $1 million, then $100 million, then billions. But compounding only works if you don't interrupt it. Buffett avoided unnecessary risks. He ignored market noise. He stayed calm during crashes. When markets panicked, in the 1970s, 1987, the dot-com bubble, he didn't run. He often bought more. And slowly, quietly, year after year, Berkshire Hathaway's value climbed. Not in dramatic spikes, not in viral moments, just steady, relentless growth. By the time most people realized what was happening, the kid from Omaha had already built something extraordinary, and he was only getting started. By the 1980s, something unusual was happening. Wall Street was loud, flashy, fast money, corporate raiders, junk bonds, aggressive takeovers. It was all about speed and spectacle. And then there was Warren Buffett, sitting in Omaha, reading annual reports like a librarian with a calculator. He didn't look like a billionaire. He didn't act like one either. But while others were chasing the next big thing, Buffett kept doing the same quiet thing he'd always done, buying strong businesses at fair prices and letting time do the heavy lifting. And here's where his strategy evolved. Early on, Buffett focused heavily on buying cheap companies, but over time, influenced by his business partner Charlie Munger, he shifted his thinking. Instead of just buying bargains, he started buying great companies, even if they weren't dirt cheap. Coca-Cola is the perfect example. In 1988, after the stock market crash, Buffett invested heavily in Coca-Cola, not because it was trendy, but because it was everywhere. In American diners, in British pubs, in Australian beach towns, billions of servings a day. A brand so strong, people ask for it by name. He understood something simple. If a company has a powerful brand, global reach, and pricing power, it can quietly raise prices over time without losing customers. That's long-term money. That single investment turned into tens of billions of dollars for Berkshire Hathaway. But let's pause for a second, because this is important. Buffett didn't use secret formulas. He didn't predict the economy. He didn't time the market perfectly. In fact, he has openly said he can't predict short-term market movements. What he did have was temperament. When markets crashed in 2008 and fear took over, most investors were dumping stocks. Headlines were screaming. Banks were collapsing. It felt like the financial system itself was shaking. Buffett stepped in. He invested billions in companies like Goldman Sachs and Bank of America, negotiating strong deals while fear was at its peak. While others saw chaos, he saw opportunity. That ability to stay calm when everyone else is emotional, that's rare. Over decades, Berkshire Hathaway compounded at roughly double the average return of the S&P 500. That difference may not sound dramatic at first, but over 50+ years, it's the difference between being wealthy and being one of the richest people in modern history. Here's the part most people misunderstand. Buffett didn't become a billionaire in his 30s. In fact, the overwhelming majority of his wealth came after he turned 50. Let that sink in. The real explosion happened because of time. Decades of disciplined compounding. It's like planting an oak tree. For years, it looks unimpressive. Then one day, it's towering over everything around it. If you look at a chart of his net worth, it's almost flat early on. Then it curves upward dramatically later in life. That curve isn't luck. It's patience meeting consistency. And despite all that wealth, Buffett's lifestyle barely changed. He still lives in the same Omaha house he bought in 1958. He prefers simple meals, cherry Coke, McDonald's breakfasts. He drives himself. No yachts, no private islands. For audiences in the US, UK, or Australia, that's what makes his story hit differently. It's not just about money. It's about discipline, restraint, and clarity. He avoided debt personally. He avoided businesses he didn't understand. During the dot-com bubble, when tech stocks were skyrocketing, he refused to invest in companies he couldn't clearly evaluate. People laughed. They said he was outdated, that he didn't get the future. Then the bubble burst. Patience won again. Now think back to that $10,000. It wasn't a lottery ticket. It wasn't crypto at the perfect moment. It wasn't a startup exit. It was steady returns. Smart decisions, avoiding big mistakes, reinvesting profits, letting compounding do what it's mathematically designed to do. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." That might be the entire story in one sentence. From a kid selling Coke bottles door to door to controlling a conglomerate worth hundreds of billions, Warren Buffett proved something powerful. You don't need to be flashy. You don't need to predict the future. You don't need to swing for home runs every time. You just need to be consistently smart, emotionally steady, and willing to think long-term while others think short-term. That's how $10,000 became billions. If you enjoyed this deep dive and want more real stories about how wealth is actually built, not hyped, not glamorized, hit the like button and subscribe so you don't miss the next one.